Welcome to Season 1 of Margin Talks by Finaloop, where we help explore the flow of money in e-commerce. Today I have Meyer on the show. Lee has built one of the most impressive collections of home brands of the last decade, being the CEO of Havenly, Interior Define, The Citizenry, The Inside, Burrow, and St. Frank. We'll hear today what it's like being atop a 9-figure business, how they've done several acquisitions in the last 2 years from a standing start, and what the future holds for digitally native brand platforms. Lee, welcome to the show.
Thanks for having me. It's great to be here.
We're going to start spicy. We're going to dive straight in. What is the biggest edge and also what is the biggest headache of going from a singular brand that you were a few years ago to now a multi-brand platform in the last couple of years?
So I think the biggest edge for us is just competency. When you see multiple brands in the same industry in particular, catering to the same consumer, you start to learn what best in class looks like. So you start to learn what your product COGS should be, because we can see what it is at scale and we can sort of figure out that we can get there. Or we can see what overseas container rates should look like, right? Because we've seen it multiple times across many businesses, and at scale, we can again go and apply that to a business that maybe isn't achieving some of those COGS. But also, I think from a marketing perspective, we can look very quickly at a marketing program and understand where the opportunities are and where people are leaving money on the table, because we've again seen it over and over again here, and we know how to speak to the customer in a different way, et cetera, et cetera. So there's a lot of just you just learn the business because you see it from all sides, and you see it pre us and post us, and you see it from infancy all the way through. And so that's been I think a really big edge for us as we've sort of developed into Havenly Brands, which is now our multi-brand platform. The biggest headache is everything else. I think one of the things that we forget when we talk sort of at a high level about businesses is businesses are really run by its people. And so very frequently these deals are really tough on people, and they're tough on people both, at the parent company, so folks that have been at Havenly, and they're tough at people in particular at the companies that are getting taken into the fold. And I think, and it's also, by the way, just tough as a management team. Oftentimes you build a culture and you're injecting that culture with someone else's culture that could be still amazing and wonderful, but oftentimes is very different. And you sort of get a lot of those culture clashes. And so often it leads with the people. And then from the people and sort of some of those challenges, you get other challenges. Well, we do it this way and you do it that way. Our way's better. No, your way's better. All of that sort of consolidation of processes, systems, people is quite a headache. I will admit, though, I really like it. I don't know that I'm great at it, but I think it's just such an intellectually, you'd think that the side of the business, when you think about intellectually interesting, you'd think it would be a lot more around sort of go-to-market strategy and pricing strategy or even capitalization strategy. For me, often some of the most intellectually interesting problems have been around people. And I think that's been a real learning for me over the last couple of years.
It's so interesting to hear about having the visibility of multiple different brands showing you what's best in class for margin or what's best in class for freight costs. I actually think that, and maybe here is a plug or at least an opportunity for our partners here at Finaloop to share more visibility, but I think it would be very uplifting for the industry, for everyone to know kind of what are best in class margin profiles and customer acquisition costs. Because you're right that so often when we talk to a brand, we're like,
yeah,
actually your fully loaded post-fulfillment gross margin is 26%. And that's really tricky to have enough room to operate. And their kind of response is oh, is that not good? Because and first of all, they're oh, we thought it was 50%.
They don't know.
Yeah, and and we're no, your chart of accounts is a bit wonky. You've got your selling expenses kind of below the line, and your freight
bloodline.
Yeah, and they're oh, is this? I was no, I think this is a really big problem. But all the data is kind of quasi-available, very easy to anonymize, very easy to share by category, by company stage. I think it'd be really helpful for everyone just to know, oh, where are we benchmarking against our peers?
I think it is helpful. I mean, I think, the information asymmetry when you're launching a business regardless of the business, is tremendous, particularly when it's your first business, or at least your first business in the category. And I think this is where, to your point, it's not that hard. Sometimes we'll look at people's like ad cost rates or ROAS, and we'll see it like get into this like crazy realm. And we're sort of like, how did you not know that this wouldn't be sustainable, or that this isn't like really where your comp set is? And again, it's not because people haven't tried to figure it out. It's the people that are giving them the data often have sort of their own self-interest in mind, right? So like, a good example is, I don't know that anyone does this specifically. I'm not calling anyone out here, but like, if I were a manufacturer in Vietnam, my best interest is potentially to not tell you that, so Crate and Barrel is getting 50% lower costs than you are, that kind of thing. And so, if there is an external third party that can sort of take, to your point, some of this data that's just out there and consolidate them, I think it really does trim down, I think, some of the lack of transparency, or almost inability to sort of operate to best in class because you just don't know what it looks like.
Jacob, here we've got the perfect setup. What are some key benchmarks a brand should be thinking about?
Yes, regarding key benchmarks and margins, I'm just going to give you a little bit of data based on what we've seen from Finaloop's companies in 2024, kind of mesh that into how you should be looking at various margins from your P&L. So if we start out from one of the first margins being the net sales margin, which is your net sales out of your total sales. So we've been seeing medians of around 86, 87, 88%. And that pretty much means that you're discounting around 12, 13, 14 plus refunds, returns, etc., which show the difference between your total sales and your net sales. And if you look at your year and weekly, daily, monthly, whatever it is, if you look at it in a more bifurcated, granular kind of way, and you see you have big dips, then that can demonstrate or signify that you do have an issue, and you should be diving into why your net sales margin is dipping to 80% at a particular point. Why are you discounting too much at that point? What do your refunds and returns look like at different points in the year, et cetera? So that's how you'd kind of look at your net sales margin, what it could be used for. The gross margin, we've been seeing medians around 55, 56, 57%. That's more or less the ranges that we've been seeing. And again, diving into your own specific P&L and looking at where you stand. Is your margin within that range or not? And if it isn't, or if it isn't at particular points, again, diving in, assuming you already looked at your sales side and now you're looking at your COGS manufacturing or non-product COGS as well side, doing the deep dive there, seeing do your manufacturing costs look good, especially compared to your competition, even looking at the non-product side, at your shipping out costs, your merchant fees, etc., and trying to deep dive and see if you do not meet the market standards, why not, and what can be improved. Now, contribution margin medians, we've been seeing around 27, 28, 29%, which generally would mean that variable marketing is taking a big chunk out of your P&L. And again, once analyzing your sales and analyzing your production costs, now you're at the last stage of your variable costs, and you should be using this portion of your P&L to deep dive into your variable marketing costs and see, are you using the right channels, the right keywords, the right agencies, et cetera, to be optimizing your marketing costs. And just one more measure, talk about the EBITDA we've been seeing medians of around 6, 7, 8%. And obviously some companies have higher and some are in loss position at the EBITDA stage already. And again, this would be taking everything above into account, but it would be looking a lot, for example, at your operational costs, accounting your depreciation and amortization. And in a similar matter for the operating margin, it would help you determine whether your operating costs are market standard, below or above, and where you can fix that up to better manage and grow your company.
You've acquired a number of brands. A quick look through Crunchbase would show quite a bit of capitalization of the brands that you've acquired. Is it fair to say that you saw an opportunity to acquire very heavily capitalized brands in your category? And then maybe a follow-up question to that is, why haven't other brands turned into platforms and rolled up their peer set?
Both great questions. The first one easier than the second, so I'll start there. Yeah. I mean, I think, look, we were all there. You write about it, I see it. We were all there in like 2021, right? Like, I think one of the things that I thought was so interesting about that time period between 2018 and 2021 was not just the capital, but what came about as a result of the capital, right? It's a bit like I have a 2-year-old at home, like a 2-year-old toddler. And if I gave him $100 million, I know that he'd spend it incorrectly because there's like no way of conceptualizing $100 million when you're a 10 or 15 million or $20 million business. I think then imagine that you have school teachers that are like grow, right? Which is ultimately like I think what boards and investors were doing, which is like if you're not getting into triple digit growth, you're not worth anything. We gave you a boatload of money, go grow this thing and become Allbirds or Casper and many of his brands that unfortunately didn't have the star yet I think they were hoping for. And so, I think what you saw when you looked at the space, and by the way, I just want to be very clear, I chased after that myself, right? Like this is not me saying like I knew better. It's just by luck and maybe a little bit by the intelligence of some people around me, we were able to escape some of the worst of this. But I think fundamentally, like that was the mentality. You take a bunch of venture capital, you then grow at quote software rates, and you spend a ton, and no one cares. I mean, what even is net income? Like no, like maybe someone would talk about gross profit or contribution profit. Maybe you talk about EBITDA, but like there's just really no tethering to I think the basics of business. Certainly a profitable business. What ended up happening, I think, is as you got into 2022, you saw a lot of these businesses, particularly in home, and I think it was exacerbated in home, but it was really kind of across e-commerce, where you had kind of an overcapitalized business that had invested a ton of capital, in particular into marketing, which inflated top line, made it unprofitable. So, you're sort of digging yourself out of a cash hole. And then two things happened, consumer demand. We always assumed e-commerce would like remain at this elevated state forever and ever. And again, home was like, gosh, home was on fire over the COVID period. Everyone sort of thought that this would be sort of the new normal. But what you saw was like venture, as interest rates rose, pulling out of the space, and you saw consumers pulling out of the space. And then you're left with a business with an inflated top line that can't sustain its top line, that is probably left with less cash or very little cash, with an exhausted capital base. And I think for me, again, Havenly escaped that for two reasons. A, we couldn't raise capital to save our lives. Like for whatever reason, I'm really bad at it, and that's okay. Again, like we just never got to that like super frothy 2021 round. So that's one. So we didn't get the pressure of it. Second, I think we're Havenly, the interior design business, is a scaled people business, and so it's hard to spin up people. Just in general, particularly designers that have to be pretty good. Like this isn't like a part that you're making. This is like a human that's doing sort of very heterogeneous, sort of taste-driven work. And so we just couldn't get to like that level of growth and really that level explosive growth that we, others of our home compadres could get to. And as a result, we didn't spend as much money on marketing, and we didn't lose as much money. We still lost plenty of money, I will tell you that. But we sort of escaped, again, I think the worst of it. And then again, we were very lucky to have investors around the table that were very rational as we came out of this and sort of supported our endeavor to really turn it around. And so we, as a result, everything's relative in life and business. You had a whole slew of companies that were suffering from, sort of a lot of the, excesses of the pre-COVID zero interest rate period. And in this hangover, and needed a way out. And we realized that we could be an excellent way out. And the reason for that is, and the reason, by the way, we tend to always buy venture-backed businesses, is venture wants to preserve upside. And what we're able to give them in a lot of cases, oftentimes there's cash involved, but there's also equity often involved, particularly in deals that aren't distressed. And so what it allows people to do is, even businesses that maybe don't need that exit right now, but they want one. They can sort of go, the founders, investors could go off and do their next thing, whatever that is. It's more valuable, but they still leave some chips on the table. So they can still capitalize on the upside if and when the market turns. They don't have to stay here in this market waiting for it to sort of turn around, whatever that looks like. And then I think to your second question, why people aren't doing it, I don't know. I've actually been curious about this. One of my theories is home is unusual because one of the reasons our portfolio works is home tends to be this event in which the consumer, while it's an episodic purchase, right? Anything you purchase for your home tends to be a less frequent purchase. When you're buying for your home, it's a pretty high signal event if you just buy one thing. So in other words, if you buy one sofa, it's really likely that you're buying other things in your home, and you're maybe designing your home, and you're maybe looking for paint and bedding and rugs and pillows. And so we use that as a data layer to help cross-market across the brands. The idea being I acquire you once and then I get, a lot of share of wallet from you across all these amazing brands we have. So maybe that's the unique thing about a home, but I actually don't really know. Like, I'm surprised, to be honest, I'm surprised it hasn't happened in apparel. I know there's sort of 3Z's done a mattress kind of consolidation. There's obviously solo brands, which we follow a little bit, but it doesn't. I'm a bit surprised, candidly, that it hasn't been done a little bit more. Given like the things I've described have been in almost every category on the e-commerce side.
Yeah. As you were speaking, I've already pulled out the title for this episode, which is When Lee Meyer Gives Her 2-year-old $100 million. So we'll have to test that we'll test that with the producer and see if it sticks. But I wonder if the kind of unique thing about home that you said, two things. One, which is like give you a tremendous amount of credit for your courage of having the activation to do this. And so once you are known in the marketplace as a buyer, I think you did your first 2 deals in the span of a couple of months. Then you've got the momentum of Lee and Havenly Brands as a buyer in market, and you have that that snowball happening. And then second of all, I wonder if it, with home specifically around kind of the back end of COVID, the COVID withdrawal that was most affected in home. Like you said, that people had bought their home products in 2020 and 21. And so home as a category was harder to sustain the top line. More so, other categories just didn't get that 2021 bump. And so maybe created a few more special situations potentially.
I think that's probably true. Like it was it's been really dramatic at home. Like the run up, the slowdown, and now even like the normalization is bumpy for a variety of reasons. In no small part because home tends to be manufactured in Asia, oftentimes China. And so a lot of the conversations around tariffs or overseas container rates has sort of, impacted margins.
Jacob, there's been a lot of noise about change in tariffs. What's the latest on where things stand?
So about tariffs. So first of all, this is being recorded before the Trump administration actually takes office. Even, I guess, in a couple of first months, it may not be entirely clear where tariffs will be heading. But tariffs are huge. I've written about it quite a few different places. It's pretty much a tax that's generally enacted on import of certain goods. It could be goods from a specific country, like 301 tariffs, which applied specifically with respect to China, or it could be what's known as other tariffs, like 232 tariffs, which are on specific items. Now, Trump has been talking about a lot of different types of tariffs, different countries, perhaps different types of goods. But what happens at the end of the day is tariffs are meant to protect domestic manufacturing, which Trump is also trying to prop up, talking about having a 15% corporate tax rate for manufacturing within the US, which we'll see if that happens. But it's meant to prop up local manufacturing by making it more expensive to import. It could definitely harm people who are manufacturing definitely in China and possibly in other countries, other types of products, making it much more expensive. Eventually, there's a good chance that a lot of that cost will end up shifting towards the end customer, but it definitely can impact business models. So it's worth keeping in mind and trying to figure out if there are possible ways to diversify your chain of supply. People are talking about different kinds of solutions, meaning it's based on the value of the imported goods. So having, let's say, a more raw version of the material being shipped to the US and doing more of the actual manufacturing work in the US would be one way to possibly mitigate some of the cost. But yeah, this is totally new, and we're going to have to see where this administration takes us. And when there are tariffs in general, there are counter tariffs, like a tariff war, which the administration presumably will take into account. So we don't really know where this will end up, but it definitely can impact those who are shipping in items from out of the US. So it's definitely worth keeping your eye on the ball and seeing where things develop here.
I know I have plenty of founder friends in e-commerce that are in other categories, whether it's beauty, which is, I think been a very healthy category largely, but you could sort of see why, this would work even in beauty, or we seem to be a little bit of the anomaly. But, I've been talking to, oddly enough, to your point, like when you started to do this and you've gotten a few deals under your belt, I will say I've gotten reached out to over the last few months quite a few times by folks in other categories who are looking to sort of activate that kind of M&A motion. So maybe we'll see it.
You've acquired several brands, but I imagine you would have passed on many more. What are the attributes, both financial and qualitative, that stood out in the brands that you did buy, or potentially brands you're considering buying in the future?
Great question. I think there's the financial. So, from a financial standpoint, obviously, like buying a company is a bit like planning a wedding. Like it's the same amount of work, whether it's small or big. Like you might as well just go big. And so, there are a lot of headaches on the other side with bigger deals, but at least you get the scale and a lot of gross profit dollars to play with. And so we try and look for deals that are above a certain scale. Try to stay away from deals that are sort of under $10 million in top line. And we like to see a very clear line of sight to profitability post deal, which is usually like us, again, stripping out a lot of fixed costs and then making some moves from a contribution profit perspective. But it's never just about the financials. I've seen so many deals that are, $30 million businesses that are break even. So with us, they'd be somewhat profitable, that I just don't think makes sense. And like, I'll give you like the street friendly answer, and then I'll give you like my version of that. And I think one of the things that I think about a lot is like, does it share a customer? Because a lot of this is like, can we speak to this customer appropriately? Can we cross market well? Do we know how to market to this customer? Do we know how to develop product for this customer, et cetera, et cetera? So like, in other words, I don't want to have a whole different design and development team just for the customer. I don't want to have a different sort of creative ethos just for this customer. I don't want a different, I don't want to acquire customers differently. Like there's a lot around the machine that like I need to have sort of work fairly consistently kind of across all the brands. I will say though, like it's just, deals are hard. It's a little bit of like, I do these deals myself personally. We don't hire investment bankers. It's like me and two 27-year-old people. I was going to say kids. And who do this. And, we do this alongside our other jobs, which are running the business and doing strategy and FP&A and that kind of thing. And so you just have to really love it. Like you really have to want it. And even some of the distressed deals we did, I wanted them. And in the few cases I didn't, I always regretted it, because in the deal process, you get into these honestly somewhat silly negotiations. Like you're sitting there at 1 a.m. and some lawyer is yelling at you about some transaction cost. And you're like, why did I do this? And so try really hard to get brands that we feel, I'm a consumer in the space. I am our target consumer in many cases. Like if I can get behind a brand and we can get behind a brand and we know that the customer is there and we know that it's resonated with the customer that we know we speak to, we get pretty excited about it. We also have a lot of data through Havenly around what brands are spiking and trending. And so, it helps us kind of validate that intuition that we have around those brands as well.
When we've bought brands, one of the prime drivers for us is some kind of headcount reduction, and there've definitely been a lot of lessons around that and how much to do. And you mentioned team at the start of the call and kind of all the magic that needs to happen with team integration. I've read that you've most typically kept headcount intact. I don't know if that's still the case, but if so, what are kind of the main value drivers post-acquisition?
So I don't don't know that that's necessarily true. I would say we do keep along a transition team. I almost never keep founders, not because they're not fabulous people, but I would be terrible as an employee now, particularly if I was working on my own business still. And, as a result, once you lose a founder, typically, as you know, in many startups, a lot of people are there because of the founder. And so you do tend to see a lot of attrition, whether voluntary or involuntary. And so I'd say it's a mix of both. We expect both. Oftentimes it's hard for, founders to hear about their teams, but, it just is sort of natural as the team sort of moves on and the brand moves into a new life and a new stage of life. However, we've often, and our leadership team, if you look at it, is fairly mixed. So William Savage, who runs all of our supply chain and ops and logistics, came to us from Interior Define. Danielle Wallish, who runs all product design and merchandising, came to us from the inside. And so we try to take some of the best of each. And I really do go as deep as I can, particularly at the more senior levels, to understand who that person is. And every brand has one or two where it's just one person that knows a lot about the business, but can extend themselves beyond the brand and can handle now 6 brands and can bring a level of knowledge, but also an openness. Because sometimes I think what happens psychologically is when you've been an integral part of a brand, and most of our brands were declining pretty consequentially year over year until we've taken them on. And most of them, not all of them, but most of them are now back to growth. But there's a tendency to get defensive when you're a part of that. And so what we look for is just a ton of openness to understanding that stuff happens. There's a lot of reasons why stuff, a brand doesn't work or the financials don't look the way we want them to, but they can get over it and see the opportunity and sort of what we're building together. And so we've definitely done a lot of that. I've actually been very proud of our ability to do that. And some of my closest colleagues, we were lucky to get as a part of a deal. I'll give you one sort of anecdote. So St. Frank was a small deal. It was a distressed deal. The 2 founders left after we closed, but we did keep the entire team, not anticipating keeping the entire team. We didn't know them. We didn't actually meet them, I think, until maybe a couple of weeks before they closed. And they've been amazing. That team, that acquisition, for those, I think it was just a handful of people, but all of them have stuck around. All the ones we wanted to have stuck around. And they've taken on, Liz Bell, who was their head of merchandising and e-commerce, has taken on a couple of other brands. She's phenomenal. I really enjoy her. And she's just been so great. And that team has really proven themselves to be open and scrappy and really aligned with our way of thinking. And again, it was just sort of a little bit of a small opportunistic deal that came our way. I guess moral of the story, you can be surprised, A, it's not always about the resume, B, and then C, attitude really matters in these kinds of transactions.
Yeah, that's so great to hear. Collectively, you and the brands that you've bought have raised over $100 million of equity. There are a lot of nascent brand founders who are listeners of the show. How would you advise emerging brands, let's call it in the $1 to $10 million revenue range, on capitalization?
Yeah, that's a great question. I mean, I guess so. $100 million is probably understating. I think we're north of 300 and change collectively.
Wow.
It's astounding. I think there are kind of 2 things to think about. So the first is, remember that when you take outside capital, and I'm really talking about institutional outside capital. I think there's obviously a whole bunch of other ways to capitalize a business. But when you think about institutional venture capital, remember that it's a little bit like taking the red pill. You can't put it back in the bag, right? You're just you're choosing a path. And that path can be glorifying. It can be wonderful. You won't have to starve yourself, for no salary. You'll get potentially some fun office perks and you'll stay at hotels instead of crashing on your friend's couch. But it comes with a trade-off. And the trade-off is the expectations and the bar gets higher and the level of exit that will be financially lucrative for you starts to get higher with each of those dollars you bring in. And then the second is, look, you're taking on other people's money. It's worth thinking through that. Even if it's the right thing to do, just remember that that's what you're doing. And there's a responsibility there that, for a lot of reasons, to understand exactly what that means for you. The second thing I'd say is just take secondary. If you're gonna do it, de-risk yourself. And I think one of the things that I look at a lot of these companies, and I get to see like what has happened over to founder salary and equity over time. In many cases, like I talk about this a lot, where it's like many of the founders and CEOs of these other companies have actually made more from their equity than I have so far from Mars. And that's because in 2021, when the juice is flowing, if you're getting passed a plate of cookies, take one. And so, I think it's like there's a little bit of it's almost like a two-sided story here, where you can get into these markets where it's really advantageous to take on a lot of this capital. And if it's right for you, you should do it. And right for you may mean many different things. Just be intentional. Know what you're doing when you're getting there. I personally would not do it again, I don't think. So, take that for what it's worth. I think there are lots of other ways to capitalize businesses. And I think it just leads to sort of this bad behavior. It's almost impossible to take an unprofitable company and make it profitable. I've done that. Like, I just did that. I can tell you it was blood, sweat, and tears. And so I think like if you can get to a place where very quickly you're self-sustaining, that's probably a better place to be.
My next question is about biggest financial learning, but I wonder if take secondaries is already the answer. But I'll ask it anyway.
Someone's going to yell at me for that.
No, I like it. I imagine that you have gone up the financial learning curve a good amount running a multi-brand platform. What is your biggest financial learning?
I think so. There are kind of a couple of things. I think that the thing that I've started to learn a lot about businesses is how much smart working capital management can make or break your business. It's not something people talk about. It's not terribly sexy. But I forgot to sort of mention that like one of the benefits of Havenly and the business model we had is we never touched the product. So the business model for Havenly was you paid us for a design fee. We designed your home. You then bought the product through us, but I just went and placed orders with my vendors. I wasn't responsible for shipping it. I got the cash up front and then, paid my vendors and it was great. And so I had this like cash advantage that if you were holding inventory or buying shipping containers or spending on domestic logistics, you did not have at the end of 2022 or at the end of 2021. And I think like fundamentally, again, I didn't realize how big of an impact that has. Like just your cash cycle is so important. And again, when we talk about self-funding, you can actually be a profitable business that has no additional cash. And if we had no additional cash, we wouldn't have been able to do these deals. We wouldn't have been, there's just like a lot that comes from that that is extremely beneficial. And that's actually one of the things that we tend to work on when we buy inventory-based businesses is how do we shorten the time where cash goes out the door and when we get cash back. And it's a big part of like sort of the model that we run.
Jacob, working capital management is so critical in inventory-based businesses. Can you talk a bit about how brands should be trying to shorten their cash cycles?
Yes, so regarding working capital, inventory-heavy businesses and the cash conversion cycle in general we've discussed this in the past, and there's a good chance we'll discuss it in the future just because it's so important. Managing cash and your cash conversion cycle is one of the most difficult aspects of inventory-heavy companies, especially when you're selling online and in seasonal types of businesses where you have ebbs and flows of lots of orders coming through in holiday season or other peak seasons, which are specific to your line of business, and then drier seasons and managing A, the inventory and B, the cash. So just in general, out of the cash conversion cycle, as we've discussed in the past, there are the three components of how long it takes you to sell your inventory, how long it takes you to pay your providers who are providing you the actual inventory, and how long it takes you to collect your bills, which is more relevant if you're selling wholesale and have payment terms of net 30 or net 60 or net 90. So obviously the shorter the cycle, A, the more cycles you can have, you can churn out more turns of inventory, and B, you can need less or ideally no external financing if your trade credit can actually finance your next inventory purchase. So there's general ways of doing this. It's not easy, but B, we've had companies that we've worked with that have significantly managed to reduce their cash conversion cycle by A, being on top of their collections, collecting faster, and B, sometimes even trading part of their gross margin for better payment terms, meaning instead of paying, let's say, half when you order your inventory and another half when it's delivered or 30 days later or whatever, extending that out for another 30 days and giving, let's say, a couple of percentage points of your margins to your suppliers. It might seem expensive, but it's very likely cheaper than the alternative of financing that period. And it's just interesting when you look at like really great companies in the consumer space, there are stories, let's say, I don't know, I heard this on Acquired a couple weeks ago, that Costco, for example, or the predecessor of Costco, managed without playing with the AP terms to actually get to a negative cash conversion cycle by just having an inventory turnover of over 12, which means they're turning over the inventory more than once a month and presumably having payment terms of net 30, which is unbelievable. So getting your inventory turnover up to, again, sometimes if it gets too high, it could be dangerous as well and it could lead to stockouts. But really managing your business well and getting your up there and shortening your cash conversion cycle by paying later and having your customers pay earlier is definitely the way to go to in managing your cash and inventory.
I think the second is, if you can, avoid fixed costs. Whatever that means for you, if that means like I think we did like sort of an unannounced deal. The fundamentals of the business we acquired was that they invested in a ton of warehouse space up front. And so they had these like massive leases, lots of warehouse workers, et cetera. And it's like, why would you do that when you could literally just use a 3PL? It's like one of those things where like, certainly at some point, at some scale, it'll make sense. But when you're a $7, $10, $15 million business, like there is a lot that you can do these days. There's a lot of stuff set up for you so that you don't have to take on fixed costs and you could scale up and scale down.
We had Ben Brachot from Dwight Funding. They're an ABL lender, and he asked all their clients to maintain a 13-week. Which I thought was really interesting because a 13-week cash flow model traditionally is reserved for kind of more challenged or turnaround businesses. But he said, to your point, kind of working capital management, he just wants the brands to be thinking about working capital management all the time.
Yeah.
And build that discipline. And maintaining a 13-week is a good way to do that. I just thought that was really interesting and probably just good discipline or good hygiene for most brands, even if they are very liquid.
Yeah, we do it we started with Interior Define. Well, we started with Havenly. With Interior Define, we had to do it because of just how distressed it was. And we've maintained that across all our businesses. And we're a fairly scaled business. But like, you have to, because, we're large enough now where you could have like post Black Friday, let's say in February when our payments to suppliers come due, you can have one massive payment, all wires hit at the same time. And while we maintain a very healthy cash cushion, we have cash covenants. So you could like blow a covenant. And so I actually recommend everyone does this. Like, even as a founder who's bootstrapping, like you'll sleep better at night when you know exactly where your cash position is relative to where you think it's going to be and what it's going to look like for the next few months.
You've got an incredibly impressive collection of emerging brands or challenger brands. What can brands like Havenly and founders like Lee Meyer teach retailer incumbents about the modern consumer?
I feel like there's a little bit of a trend these days to, as an upstart or a newcomer, to talk about where incumbents have gotten it wrong. I think largely they've gotten it right. And I think what's interesting about that is the things that they're not getting or they're not understanding is not because someone on their team isn't understanding it. It's just because it's a small signal amidst a very large business. And I think that's like one of the things that I've sort of been interested in watching. A good example is just like customers very frequently at a smaller scale vote with their feet. If you're, however, a very large company, say, let's like a Williams-Sonoma, you're sort of more in the if I build it, they will come mode. And that's okay. You're huge. You got stores everywhere. That makes a ton of sense. And I think what I encourage people to do is like act like your customer is voting with their feet. Like, where are you seeing signs that there is a little bit of a pullback? Where is the downturn not a macro downturn, but a downturn in how you're executing or relative to the market? And I think those are the types of things that I think, like, when you're a smaller brand, you feel it. Like, if I'm off on a product, like, I feel it. There is no sale because, our brands are relative newcomers in the world of our consumer, and we don't have retail stores everywhere. And so I think that that's like a bit of what I've started to learn as I've looked at some of these and gotten to know some of the folks in these larger brands. I think the second is, like, just remember that the rising and this is home, I guess, if you think about e-commerce and the consumer journey, the reason e-commerce and home is so interesting to people now is because the digital generation, so this generation that like made Warby Parker happen and made Glossier happen and Allbirds happen and whatever else, that generation is just aging into their prime home demographic. So they're just hitting home, say, in the last 3 to 4 years. And so this consumer, when I look at the home industry in particular, I think other industries have already felt it because the consumer's been living there for a decade or so. Home is new to this consumer, and this consumer just is different. As every generation has like sort of differences. Price transparency matters. Like, there's a lot of value bias. So like, you can't, the like $14,000 sofa when you can get the dupe for $3 is just not going to cut it anymore, right? Like, you really need to start thinking about that, particularly in a category as unbranded as this one is. And so I think there's a lot of like, just like, look at other verticals and how this consumer has shaped those other verticals. And then remember, it's coming for home too. And if you can get ahead of that, awesome.
As we head towards a wrap, Lee, this wouldn't be a consumer podcast without asking, what's in your cart these days that you're excited about as a consumer out in market? And then what's a product in the portfolio that you're loving that listeners have to go and check out?
Okay, so this is a little bit strange, but I have been loving, from a brand perspective, Hims and Hers. I think it's so interesting to be able to take something as unsexy, originally as like, is it hair loss drugs for men, and like make it just like a normal part of the conversation for a whole generation. I think that's really interesting. It's not like something necessarily I'm excited about buying, but like I've used Hers recently and I just was like really impressed by the experience. In frankly, a world where healthcare experiences kind of suck and like access to medication involves a whole series of steps that are annoying. This made it pretty easy, and I thought it was really fun. However, what I really have in my cart is an Hermes shawl, cashmere shawl, which I've been thinking about pulling the trigger on for a little bit, and it's beautiful. And luxury is not dead, people. It is fantastically well and alive. So I personally am super, super excited about some of the launches we've done on Interior Define this year. I think the team has done, over the last 24 months, an amazing job at bringing some things to market that have been really phenomenal. My favorite thing is actually, we just launched this beautiful sort of slip-covered sofa. It's actually named after Havenly's founding COO, Jesse Dixon, who's tragically passed away last year. So it's called the Dixon sofa. It is both classic and timeless. It's slip-covered, so you can wash it, and it really just feels like of the moment in a meaningful way. And it gives back a little bit. So Jesse, the namesake of this sofa, was a huge supporter of an organization here in town, and so some of the proceeds from the Dixon actually go back to that cause. Hugely excited about it. It's been doing really well, and so wanted to call that out for folks that are in the market for a sofa.
Amazing. I love that story. And it sounds like for home brand owners that are trying to get a head start on their sale to you, sending a Hermes shawl would be a good way to do it.
Yes, fantastic. Let's do that.
Lee, thanks so much. This is a blast. I really appreciate you sharing all your experience and insight with our listeners.
Thank you so much. It was fun to be here.
Thanks for listening to Margin Talks by Finaloop. Don't forget to like and subscribe on the channel you're listening to. If you have any questions or feedback, feel free to email me, fan@thehedgehogcompany.com. And if you'd like to see what Finaloop can do for your e-commerce business, please visit finaloop.com. We'll see you on the next one.